And Friday session is not mandatory, right? It's mostly office hours. But I just wanted to let you guys know that Sky from Friday's session will be joining as more like a guest speaker today. And I've asked him to go over the revenue multiples again, because I think that was some good information. So for those who missed it and those who want to review it again, as well as he is going to, I worked on the waterfall analysis myself, but I'm so Excel beginner. So I asked him if he could share his waterfall Excel spreadsheet, which is already, you can play around with it. And he said he'll go over it and he'll send it to us so you guys can have that as your resource as well. And the third thing he is going to go over is how to calculate your IRR. And I wanted him to go over the IRR part because it's kind of important. I wanted you to see it from the venture perspective. Not, from angel perspective, we'll go over it again, but from a venture perspective. So while I had him, I wanted him to go through these three things. But before he comes on, he's probably going to come on around 5 o'clock, Kate, because I want to make sure that we have a solid hour to go through this with him. And as far as, I am concerned, you can ask me any questions later on. But if he is only going to be available for a short period of time, I want to make sure that, we get to ask him all the questions that you guys have. So I hope you don't mind that you only get to hear from me for a little less than an hour, but I think it'll be well worth it, and we can always catch up later on. So today, what I wanted to cover was I wanted to first go over a due diligence deck that I did, and I'm waiting for. So I did this with Grant. So this is the syndicate I ran with him, and I've asked him for permission so I can share it with you guys. But I think you guys will get an idea about the kind of due diligence that I do or I get involved with. And after that, we'll just go dig a little bit into the valuation. And then by that time, it'll be time for Sky to join. Is that all good with everybody? Sounds good?
Yep.
All right, sounds good. All right, let me share my screen. Okay. I assume I have the rights.
I should have handed it over, Jag, so you should be okay.
Sounds good. So, okay, so this is, can you guys see this? Can you guys see the deck?
Yeah, looks good.
Okay, it's called, so this is the company we invested, we ran the syndicate, Made in Space last year, myself and Grant, and it got acquired this year. And the multiple wasn't what we were hoping for because we came later in the game. So, but I wanted to just go through this deck with you. At the time, sorry? Did somebody say anything? Okay. At the time, I was very new into understanding how do you evaluate a space company, right? And how do you put a valuation to something? So I have shared with you guys, my $3 to $6 million valuation, most of the companies that I look at. This doesn't fit into that category. So I just want to be, upfront and say that everything that I've taught you, that the way I do things, I have not followed it into this particular company. One reason because space was, extremely new space for me, as well as I wanted to get the experience of how to evaluate a company that is in a vertical that is so frontier tech, right? So anyways, let's go through it. And I'm going to go through it very quickly. There are 45 slides. I'm not going to go through all of them. Once Grant gives me, okay, I'll share this with you. But this is being recorded, right, Kate? So you will have this anyway.
Yep.
So, okay.
And Jags, I don't know if we can start out with a quick question, but Angel has, you were just talking about multiples and mentioned that multiples weren't what you expected on this deal. What do you consider good from your perspective, or is it all on a deal by deal basis based on kind of how you're calculating and looking at the deal?
I think the overall, the average, right? It depends on the industry, not as much as a deal per deal. Depends on the industry. So, like for food industry, I'd like to get, about, 3 to 5x. For tech company, 10 to 15x is what, where what my hope or desired outcome would be around. But as I said earlier, this is something that it happened within 18 months of raising money doing the syndicate. So, anyways, this is like a executive summary that you get from founders. So all the slides here are put together by me and Grant based on the investor's perspective, right? So I won't go into every single detail, but this is the spreadsheet that I use for a quick look at where is this company, what is the highlight of this company in each of the areas. So I look at industry, market, problem, solution, revenue model, and everything here should be familiar to you by now. ARR, revenue growth, gross margin, LTV to CAC. Who are the partners? What are some of the key tractions they've been able to achieve? What are the competition? Who are the team? How much is raised so far? And what were the previous terms? And what is the raise? How much are they raising and how much is committed? And new pre-money and post-money valuation, current and new investors, and what are the risks, right? So this is a pretty good snapshot of where the company is, from an investor perspective. So in summary, this is what we wanted to do. We wanted to raise, so they were not raising a round, but some of the founders were converting their common stock into preferred stock. So that's why we wanted to make sure that if we get an allocation, all the investors coming in, the shares will be converted from the common shares to the preferred shares, and with a 1x liquidation preference. These were the investment terms. So the total investment valuation, who were the lead investors, new investors. So now we are breaking everything that you saw in the thing slide 2 into more details here. So liquidation preference, these are the investment terms that we were asking for. Closing, approximately when. What are the other terms that we wanted? Information rights, pro rata, anti-dilution, standard wraps, and warranties. I don't know why we put, and then previous terms are 10% discounted safe note, that was outstanding. And some of these things I may not be able to answer if you have a question, but I can ask Grant, because he also was he's a space expert, and so he was lead on this due diligence. These are the capital raised to date and terms, right? This is the cap table. So who owns what, right? So they were 64.64% warrants out there. They were 15.85% option pool. We talked about option pool between 15 to 25%. And this is the common stock purchase. We were actually purchasing 3.33%, which is equal to $2 million from the common. So if we invest 100K at this valuation, our ownership will be 0.17%. This is the investment thesis, made in space. Where are they in terms of all of these bubbles that we look at to understand, do they fit into our investment thesis? Again, the problem and need from an investor perspective, the entrepreneur will always give you their version of it, but we always try to understand the problem and put it in the words, or articulate it in a summary format as much as we can for the people we are bringing in, the other investors, from our perspective. This is the solution. So this company, what it made was they took all the raw material into space to create what they needed in the space. So it's a 3D printing company that made parts in the space. So what the problem was that, like, sometimes they needed to have like a 30-foot robotic arm, right? But they could not do that. It would be very what do you call they could obviously do that on Earth and take it to space, but if we could do it in space, we can print it in space and use it right there and there, that would save a lot of carrying unnecessary cargo, or making sure that, okay, we thought it fit but it didn't fit. So a lot of those problems were solved because we were doing on-site assembly and printing of the parts that were needed. They got acquired by a private equity firm.
So Jags, I remember you talked about, what's the problem that the company is trying to solve, right?
Mm-hmm.
And if you just go back to that prior page,
Mm-hmm.
It's kind of in a new space in a way. Oh,
Mm-hmm.
okay, here you are. Right. I mean, I'm just like, it's an innovation on perhaps a problem, or it's an improvement as opposed to its own problem. I'm just trying to understand, when you're disrupting and you have an innovation, how you synthesize the problem, because perhaps people don't know that they want to print 3D in space, right?
Right. And what is the and why is it important, right? To print it in space versus here,
Exactly.
what's the saving, what's the, all that stuff, right? So I am attracted to the industries that are solving old problems with new technology.
Okay.
So having something like this, having a part in space to repair a space station or whatever, it's not a new problem, it's an old problem. But we are actually putting in the technology that exists now that can allow us to print on demand, basically, with the raw material and with the whatever you need in order to do that print on demand, not just on Earth but in space. So I'm not sure if I answered your question, but what I'm trying to say is that the words like disruptive, innovative, it's, for me, are you solving the problem that already exists but in a new way that saves time, money, resources? How is this better, right? Versus, is this a problem that very few people know and care about, and you are solving it? But in this case, it's a problem that very few people probably know and care about, unless you care about the frontier technology, what's the innovation happening in there, and how could this solve problems in future. I think Angel is trying to, okay, I'm admitting her. Okay. So
no,
Betty,
I think that answers it, right? Because you're improving on an old problem with the added lens of your thesis,
yeah,
which I don't know if this is SaaS or not, but with the added lens of your thesis, which is new disruptive technologies in, I guess, space, right? You said you're interested in space. So
yeah.
I just was trying to connect the dots between not necessarily a problem that's so evident and then your thesis, right?
Yeah. So that's why I allocate 25%, and it's not always 25%, right? 25% of my
Directionally.
portfolio, it goes towards things like this, or something that doesn't fall into the other three categories. Also, in this case, it was more of a curiosity. How do you evaluate a company that doing things in space that I probably won't be able to touch, feel, whatever? How do you or experience the direct benefit? There's another company I'm looking at now is in cargo space, right? So the ocean liners, like ocean liners, the shipping, the big ships, they are, they're very useful. We've been using them for, centuries to transport goods. But how about, what if we had a cargo, a plane, an autonomous plane for for a ship that just is all at it is like you can put containers and containers of cargo in it and fly it up in the air and then deliver, right? So it's something also solving an old problem with new technology. If 10 years ago, 15 years ago, if somebody told me about Tesla, that the Tesla is a car that I'll be able to, auto drive, I can summon it, it is actually going to prevent, I'll be like, oh, I'm not sure, right? This could exist. So now I'm looking at things like having a plane that is like an ocean liner. It seems like, oh, that can't be done, right? You can imagine putting containers and containers in that and flying it autonomously. So anyway, so yeah, my 25% falls into that category. Sorry, I spent too much time on that. So space is picking up, right? Especially with Elon Musk, SpaceX, and Blue Origin, focusing on different parts of the space, Mars and Moon, and where we are, things are becoming more possible, right? So then we evaluated the market, right? What is the market for space, right? So space for Earth, and terrestrial development. So this is what we actually grant found this, and what are the the end of 2019, end of 2020, 21, 22, how do we see this segment growing? So obviously you see that in the budget, it is growing pretty phenomenally. But what I found that's most interesting is that the extraterrestrial development, it went from 2 billion in 2019 to 7.2 billion. So that's, to me, it's like, okay, now we're looking at things completely differently right now in all areas of space.
Jags, is this the same as a TAM? When you
Yes.
say unweighted pipeline, I think of like a sales pipeline.
Yeah.
Okay.
Yeah. So it's total unweighted pipeline. So pipeline market, yeah, total addressable market.
A TUP.
Yeah. Yeah.
Okay.
This is a little bit about the company. So what I'm trying to give you a flavor of what kind of due diligence that we do once this is an investment deck, right? What kind of due diligence we do in order to make a decision after we made a decision and present it to attract other investors. How do we tell this story? Just like founders, how do we tell this story to other investors? Traction, like they were awarded contract, $100 million from NASA. This was in the pipeline, 49 patents granted. This was the cash, they've been cash flow positive since 2010. They are pioneered in 3D printing. So these are some of the things like traction plus differentiation, right? What are some of the things that differentiates them? And what have they done so far?
Hey, Jax, this
Yeah.
is Christy. I have just a quick question on this. How is this like as thorough due diligence as you do on every deal? Like, are you putting in this exact kind of format?
No, I do this only if I'm leading a syndicate.
Okay, thanks.
But if I do version of this, if I'm individually investing, but what this gives me an idea is what are some of the things I should be thinking about in a way, whether I'm doing it to, as a leading a syndicate or, on my own. Does that make sense?
Yeah, I assumed that you weren't doing like a deck if you were just doing it on your own. So I was kind of wondering like, how much do you do if it's like you're just looking at it one-on-one,
Yeah, I know also one of the reason, okay, so there are 3 reasons I wanted to share this with you. First, just for the information purposes, right? anything on these slides should not be new to you. It could be, you may not have mastered it yet, but you must have, you should know what it is, or you could, pick up a phone call and ask somebody. So these are the things that you should know, and you will become more and more used to calculating some of the things, etc. The second reason I wanted you to know is that if you do end up investing in a syndicate, right, you should get a detailed version like this in order for you to say, do I want to be an investor in this company? So if you are asked to invest money in a syndicate, ask for something that kind of resembles this, because the lead investor should have done their due diligence, and because then that's the reason you should be relying on them. And if you are going to do part of the syndicate. And then the third thing is that if you do end up leading a syndicate later on, then you also have an idea about what would be something that I need to put together and to attract capital into this deal. So those are the three reasons. And I figured that I will use this time to show this to you now, because next week is our last week, and next week we're going to be talking about portfolio and branding and stuff. So I wanted to make sure that I give you at least a week or so to digest this, ask questions, and etc. So anyways, the first mover advantage in a relationship driven industry, right? So these are some of the milestones that they have been able to achieve. And again, we got this information from various sources, talking to founders, to doing our own due diligence, understanding who are we connected. Grant is very well connected into the space industry, so he was able to do a lot of this phone calls and due diligence, etc. And we kind of put it together. But you will see there is NASA, and then there is Lowe's. Why Lowe's? 3D printing, right? They're interested in that technology because that technology also, Lowe's have a venture arm, innovation arm. So does Target, so does Home Depot. So to be able to attract some sort of a variety of ventures, I mean, in how they have built a relationship with this company. And at any point, if you feel this is too much, I can stop, okay? So my intention is not to overwhelm you, but my intention is to just give you a flavor. What's their business model? Made for space, made for Earth, and terrestrial spinoff, right? So these are the three areas that they have products that they're developing.
Jags.
Yes.
We do have two questions, just if you don't mind.
Yeah, sure. I can't see you guys, so please.
Yeah, no problem. That's what I'm here for. First question is from Angel. You were talking about leading a syndicate, and I know this is slightly off topic, but while we're sitting here and going through decks versus other processes, she's wondering, in your opinion, what advantages there might be for anybody to think about leading a syndicate, or why you might find it advantageous.
It establishes you as a player in this space, not player, but an investor rather. So if I am interested in some space that, and I know a lot about it, it kind of labels me as somebody who looks at deals in this industry. So I get a better deal flow, quality deal flow from that industry. The second is, it is also, I think it's a great experience if you are wanting to, be part of not just being an individual angel investor, but you want to grow in this career. It's great to do a syndicate on your own, lead a syndicate on your own. It kind of gives you a flavor of what would it be like if I did have my fund. How do you raise money, but at a much smaller scale? How do you have conversations with investors? What are some of the questions that I should be thinking about? So yeah, if that makes sense.
Is there a deal size that makes sense to lead a syndicate with, or just in terms of a rule of thumb?
When you say deal size, are you talking from
Around
valuation
size.
perspective? Around size.
Around size, yeah.
I've seen syndicates from like $100,000 to 2 million.
Wow, 100,000 seems small, but okay.
Yeah. But
Yeah,
there
I've
are
actually seen a
industries.
couple a little lower than that too, but
Wow.
not too much, but a little bit.
Okay.
Also, syndicates can happen at they don't need to happen at at a later stage. Later stage is obviously more money, and syndicates usually happen also if there is a bridge round or something that the company wants to get the money rather quickly. They can I've seen that too.
Yeah, the smaller rounds I've seen are just as Jag suggested in earlier stage companies. So where a minimum, you might even have a firm coming in at 50K or 100K, you might also see a syndicate in. And maybe you've got a couple angel investors floating around at kind of the 10K level, and they combine themselves to get a 60 or 70K check-in. So those are, you won't see that very likely any past seed. Most of it's going to be early seed, pre-seed.
And there are fees associated with setting up a syndicate, right? It's a SPV. And also there are fees associated if you were to be part of a syndicate, that you may have to give away to the lead investor. So that's another reason to lead a syndicate is, sometimes you get to take a carry. Most times you get to take the carry.
What kind of number is that?
2% management. Well, either it's 2% or it's $13,000 to $15,000 to set up SPV syndicate, and that is spread out among all investors depending on the percentage of in the amount they contribute, or it could be the flat fee. There's several, and then the 20% carry to the lead investor. And the lead investor is going to most likely put 40% of the money, 30 to 40% of the money in the syndicate. Usually. What was the second question? I know you said there are a couple of questions.
Yep. Second question from Constance is, how do you diligence the firm as a syndicate?
How do you, sorry, say that again?
How do you diligence the firm as a syndicate? And Constance, I don't know if you want to pop in and clarify that.
Yeah, I'm not sure I understand that. Can you?
So, when you do an investment and you're going in a syndicate, like from what you mentioned, Jax, there's Grant who is sort of knowledgeable in that area. But when you do your diligence in terms of talking to the founder, going through financials, how do you guys divide and conquer? Do some of you look at what's available on projections, financials, valuations, and maybe Grant goes and looks at comparables? I mean, I'm just trying to figure out, like, how do you guys divvy up the roles, and what's a good way to divvy it up too?
Yeah, and it varies. To me, in a syndicate, that's why I like syndicates, is because I can bring another partner every time. I don't necessarily have the same person versus in a fund, right? And it's the same partner, same GPs, and that works really well too. So I'm not like saying one is better than the other by any means. All I'm saying is, for me, it works because I like to get to work with the person who is an expert in something, get to learn from him. So in this case, I learned a lot about space technology, who are the players and there's so much space innovation that's happening all around the world. So looking at it, the total market, who are the players, who are the even countries that are innovating big time in this space, and who are some of the big names from those geographical regions. And then the second layer is understanding the market and really looking at the problem. Is this a problem that that exists? Talking to the customers, et cetera, et cetera. And obviously, alongside that is looking at the financial. Is basically is what founders are telling me, is that what they are doing and saying, what they're saying, is that true, right? And you can only know so much, right? You're going to know as much as they give you, because they're a private company. So in this case, we divided up any kind of a space tech related conversations, Grant led, and I was always, in part of it. And the conversations around customer conversations, doing the due diligence on the team, looking at the market size, I led. And Grant was always, there for conversations. And individually, indirectly, we went and we did our research together, and we came back. And this was done over like 2 weeks period. So it was pretty intense, because for me, it was very intense, because I was getting exposed to this, for the first time. So I had so many questions, but I learned a lot.
Yeah.
And Kate, is it okay if I go through this, or do you think we should go through the processes and stuff? I just, if people prefer the other, then I'm fine with it.
I think that this is good. Unless anybody has any specific questions, I think we're good, Jags.
Okay, perfect. This is a financial summary, right? So even after looking at oodles and oodles of Excel spreadsheet, I don't do the calculation or formula, make the formula or anything. So the Grant did that. I kind of double checked everything, that we transferred things, etc., right? He is really good in that. So, so most of this was, I would say, I double checked it, but a Grant kind of acquired it. I was in conversations, but he led most of the conversations as on this slide. But this is the financials and breakdown by, breakdown by the 3 revenue streams: made for space, made for Earth, and terrestrial spin-offs. So when you are looking at the financial summary, I think one point I would like to make here is always go back to the revenue streams, like which revenue stream do they have, if they can, right? In early stage, sometimes they don't have this information, but, if you're investing in a Series A stage, then they should have this information. So which revenue stream are you getting, get the breakdown of that per revenue stream if you can. So for example, if they have a product, get from the product side of the financials, and also subscription side of the financials, services side of the financials. This could be the 3 different revenue stream.
Jags, I have a question about the last slide with the,
the
numbers.
It's
Jory. So interestingly, just looking at this one, the revenue went down.
From
year 3
to 2020.
So how alarming are those kinds of numbers? And also, you had mentioned something about profitability, and I mean, so many startups. Maybe it depends on the vertical, but they don't get profitable until farther down the line. So, do you have any just red flags that you look for?
So so if you look at in this from 2019 to 2020, they went down. So for example, the first 2 boxes, made for space, they went down, in space manufacturing, right? So but their COGS went up. And then the second, so I think there were some R&D related cost that they were accounting in this from 2019 to 2020. But at the same time, this is such an it is really, really hard. This company has been in business for 10 years at this point. So it is very hard to look at understand the profit margins, understand the revenue stream in early stage company. So alarms did go off, and we did wonder, why are you guys not, so in this case, we only received this allocation because the founders wanted to sell some of their shares. The company was not raising money. the founders were selling their percentage of their shares, and they were going to convert that into the preferred equity, from common to preferred. So this was not a usual round where the company is getting investment, but this was actually the founders said, we've been at this game for so long. We need a break. We need to pay for, we need to buy a house. We need to pay for kids' college, whatever it is, right? We need to have, so we want to convert some of the common stock into the preferred equity. And that's where the allocation came. And that was also another reason I wanted to bring this to your attention, is because if you are looking at a company you really like and they're not raising, there's always an option to, I'm not saying to go and talk to the founders and see if they want to sell the stock, but there is always also a secondary market where the founders are selling their stocks, like EquityZen. I'm not sure if you know about that, but they could have gone to EquityZen, but EquityZen was taking a lot of big portion of their the raise, so they came through grant to us. So that's a long answer to your question, Jory.
And it's a 10-year-old company. What stage are they in?
They got acquired, right? I mean, they got acquired actually 7-8 months after we finished this, and that's why I was. That's why I started out saying that we didn't get the multiples we had hoped for. Yeah.
Okay.
Past performance and projections. I always say that projections, when you look at the projection, you want to really understand what happened in the past. And in this case, they do have a 4, 5, 6, 7 years of past to really give you that information. So ask as much as you can about the past revenue, and then the future revenue. I always kind of divide it in half when I'm evaluating a company, and we'll go through that equation too. Let me quickly go through this. There are a lot of sites, and then let's jump into the 4 things I want to talk to you about. Competitive landscape. What is a manufacturing landscape looks like? These are the people who are playing in this space. What is the exit strategy? Potential acquirers, they didn't acquire, none of this company acquired them. It was acquired by a private equity firm. What are the recent exits and revenue multiples and the acquisition price in this space? This is the waterfall and return analysis, which Sky is going to go through, and he's also agreed to give you guys a blank template so we can all play with it. Risk analysis. What is the risk at the end of the day, right? I mean, everything looks good, but there's always a risk. Something you really want to make sure that you actually put words into describing a risk. Active due diligence, this is what we are doing. What does the data room have? Data room have this documents, etc., etc. And how do we, how do we plan to support the portfolio? These companies, they help find key hires, connect company with customers, and we would have participated in a Series A round. But then, I have like 30 more slides. Then they have a Europe one, so we won't go through all that. But if I have permission to share this, then I will send it to Kate and she can share it. All right, I'm going to stop this. I want to take a minute, ask you guys a question. Ask if you have questions.
I have a question.
Sure.
Okay, so if you're investing early in like friends and family or a seed round, something like that, and you're investing in an amount that you think is like, it's obviously you're not leading anything and it's small, but it's significant to you. Is like, how much do you know, like how much is too many questions to ask
Okay.
founders, or like how much is too, like how do you know the appropriate amount of due diligence if you're doing it on your own? Like when I've invested through 37 Angels, I get or I participate in a group that's doing a thorough memo. We're meeting with the founder. We have calls afterwards to follow up. Like other people are reviewing the memo.
Mhm.
That's really thorough. But when I've done it 100% on my own, I'm like, oh, are they going to get totally annoyed that I'm taking all of this time for just my like $25,000? But that's really significant to me, you know, but it's, I
Exactly.
understand it's a small part of the pot.
Yeah. So before I answer this question, let me ask you a question. Do you have a desire or ambition to be working in the VC space full-time, anytime in your career? I think you're muted.
Sorry, yes, eventually, yes.
Okay. So there are different kinds of angels who want to, who have a full-time job and don't want to be in VC full-time ever in their life. Angels who want to do the other side, which they want to become a VC or a fund manager or whatever it is, right? If you do have the desire, I would say ask as many questions as you need to. Do not think that 25,000 is a small amount, especially if you're doing a family and friends round. It's a significant amount because that's when the company is, not as valuable. So you want to make sure that I think somebody's trying to enter. Anne. Okay.
Getting her in.
Okay.
Okay.
So to me, the early stage investment, friends and family round, that $25,000 can be a lot of money if the company is successful. And if the company is not successful, it's only $25,000. So that's why I believe actually in doing as much due diligence as I possibly can in early stage, because I want to make sure that my $25,000 counts for something that is big. And earlier you invest, bigger your return multiples will be. And that's why in order to keep the bigger multiples, you need to do the due diligence. You need to read the due diligence memo. You need to get involved as much as you can. Because that $25,000 in Series B, I would say, I'm not even doing the due diligence, just let it go. Because that time, the timing of Series B will not give me as many multiples as if I were to do a due diligence much early and doing it thorough and knowing that I have done everything I possibly can to get 10x of my $25,000 versus 1x or 2x later on. It's just like, in engineering, you find a defect. They say a defect that is found much earlier costs you much less later.
Right, 100%.
Right? So it's kind of that kind of mentality. Due diligence that's done much earlier will give you a chance, a probability of you getting greater multiples or success is much higher. That's how I see it.
Okay, thanks. I was just wondering, like the one-off, and like where I'm doing it one-on-one and dealing with a founder, like in, a deal that I was able to find on my own or that came to me, versus when I'm in like a syndicate, basically at that stage, and what's like a big contribution on my end, but probably small compared to the rest of the round, is like I'm part of a bigger group and I have a better, like I have more clout that way. So I just wasn't sure how much time is really appropriate to take up.
Just to finish that, I want all of us to rise to that challenge that, if the founder doesn't appreciate the questions, that's not the founder that you want to invest in. Because it's just, let's rise to the challenge. Let's just say, I'm going to ask questions. This is the money I'm taking away from my parents, my children, my sisters, my dog, whatever it is, it's your money. I feel that way.
Thank you.
Sorry, Kate, go ahead.
Well, Jags, and Christy, just correct me if I'm wrong. I didn't know if what you were also talking was a little bit of an etiquette question if you're in a group and feeling like you're taking a lot of time on your own personal diligence. Is that what you're asking?
It was more like, I've done it both ways. I've invested on my own one-off. I've also invested like through 37 Angels with other people. And when I've done it with other people, because I'm doing it in a structured environment, the due diligence is far more thorough, and we're spending a lot of time with the founder. There's a memo. It's like very legit. And I have a much better idea of where my money's going and what I'm investing in than if I'm doing it on my own. But I'm also like, the amount of time that I would take up with a group of people would be the same amount of time as if I'm doing it on my own, if I did the same research, but I'm contributing a much smaller amount than if I'm with a group. So that's kind of like, I was not really sure, but when Jag said, if a founder is like balking at your questions, and I had that happen once, and if I have a bad feeling in my gut, I'm done, And so if somebody doesn't want to answer legitimate questions, then I do not want to invest with them, whether it's in a startup or elsewhere. So I get, if I were being inappropriate and taking up like their whole day, but if it seemed reasonable, then I agree. It's your money. You have to ask the questions.
Now, having said that, I also don't agree with investors who take a long time to make decisions, right? They literally, ask founder to dance on one leg while wearing a, kilt or whatever it is, right? That also is annoying, and it actually, a lot of founders end up wasting a lot of time, and at the end, 2 months later, they said, sorry, we are not investing at this time. It's like, what? Give me more than that. You don't want to invest? That's fine. But don't be one of those investors either who ask questions after question after question after question, and every week you're like writing this long emails to the investors with all the answers, and the investors at the end of 5 weeks says, sorry, I have decided not to move forward. So if you know it in your gut, and if you go with, there in the early stage, there's only so much you can find out, only so much due diligence you can do, right? And the most of the due diligence at early stage is knowing the founder and knowing how they are, the executors, do they have what it takes? Idea is 99, 1%, execution is 99%, right? That's why MySpace failed, Facebook didn't, right? I mean, we have examples after examples. So what I'm trying to say is that there are angel groups who charge founders to come, then they ask questions after question, and then they decide not to invest. There are angel groups or individual angels who take a lot of the times from entrepreneurs. So don't be one of those, because founders do talk to each other, just like investors talk to each other. Any other questions? No? Okay. So let me at this point share the thing that I wanted to share, which is, today's, it's a very, not that many slides. So, and then we'll go from, okay, hold on 1 second, share. Can you guys see this slide? Okay, someone say, because I can't see your faces. Can you guys see the slides?
Yes.
Yep.
Okay.
Yes.
Okay, perfect. So I want to talk a little bit more about valuation, right? Especially early stage valuation, because I think that is something that is really, really important. And so there are four, hold on 1 second, what happened? Okay. So this is what, today's, this is what we're going to discuss. So I did not put the made in space deck, but I want to talk to you about the weighted method, the VC method, and the market driven method. And then we'll go through the example of all three. Actually, I had four. And then the sky, as I told you, will go over IRR, waterfall analysis, and insights on the revenue multiples, which he shared earlier. Sorry, I forgot to remove this financial preparations. I got it from the template, and so ignore that part. Okay, so what is weighted method? Weighted method is based on the most important criteria. So the most important criteria we talked about are the founders or the team, the problem, the solution, the market size, the traction, revenue. So whatever are the criteria that are important to you, we are going to attach a weight to that, and we are going to attach a score to that. Then we're going to multiply the weight, and then we're going to do an example, weight with a score, and we're going to come up with a factor. And whatever factor you come up with, you look at the average valuation of a similar company in that industry, you multiply that valuation, the average valuation, to that factor to come up with the valuation for this company. So let's do an example. Okay. So here are, let's say these are the 6 criteria, and I changed this per company because for a food company, this might be, the problem and may not be that important versus a tech company, right? So I list the criteria that are important for me for this company. Sorry about the typo in criteria in this particular company. And then I put a weight around it. So what weight would I attach to a criteria for me to feel that in order for the company to be successful, this is the weight I want to attach. So the team in this case, I'm putting a weight of 30%. Market size, yeah, it's important, but it's not as important as a team, right? So 25%. And these are all the numbers based on my experience. There is not a magic formula that I know of that I'm using, but these are all based on experience of the experience I've had, the conversations I've had with people who invest in this particular industry, whatever that industry is, and just reading information about this industry. Differentiation. How are they different from their competition, right? What is their advantage? Traction, revenue, problem. I attach weight to that. Then I score them. So 1 is the highest score. So if team is important of 30, I put 30% weight to that, and I feel that the team is really good, then I put a 1, score of 1. So 1 is good, 0 is obviously not good. And I hope there's not 0 usually. And if there's any of them is a 0, you should definitely, in my opinion, that's either you reevaluate or you pass. Market size. Market size is pretty good. It's over 10 billion. The market TAM is equal to 10 billion. SAM is equal to maybe 1 billion, and the SOM, serviceable addressable market, is anywhere between 100 million to 250 million. The closer I am to 250 million, I'm going to put a 1 score of 1. Not close to it, market size 0.75. So you go through that for all the criteria, and then the factor is weight times score, 0.3, 0.1875, and then you average it at the end, 0.65. So you take the total, you add it up, and you say, okay, for a company like this, in this industry, what is the average valuation in the stage that they are raising? So for this example, we'll use the number 5 million. And then the valuation for this particular company is 0.65 times the valuation, average valuation. Questions?
So the way that you did the weighting was based on your arbitrary pick of those 6 criteria against it, right? Against the company. The score was also, I missed how you assigned the score.
So
Was that also arbitrary?
So it's not an entirely arbitrary, but it has a, so if the score is from 0 to 1. So what I said is if you say let's say the team, right? Team, I'm weighing in a way, putting it weighted average of 30%. I'm putting the weight of 30%. If I say, this is not the team that I think this can pull this off, I would put score of 0. If the team is excellent and everything that I feel that this is the perfect team to solve this particular problem and lead this company, the score would be 1. And then I do it by quarter, right? So the closer to the perfect, you get a score of 1. Closer to the, not good at all is 0. And what I said was, if you have a score of 0, then you need to either pass on the company in any of the criteria or reevaluate to see, did you miss anything if you still like the company? Does that make sense?
It does. Thank you.
Okay. All right. I am going to go to the few more.
Jax, where are you getting your average valuations for the industry?
I just Google. I talk to other people. Like, for example, if somebody says, oh, we are the Uber of, Uber for cleaning industry. I look at what are the, innovation that's happening in the cleaning industry and the clean, and what, has there been any companies? And you look at the Crunchbase, right? You look at the name of the company, you enter in the Crunchbase and it tells you how much did they raise. And then I said, okay, if they raise this much, and usually is around 20%, then I get the valuation of the company. Make sense?
Yep.
Yes? Okay. So another method is the valuation method. So based on what percentage is given away in this round. So what you do here, all right, let me, hey, Kate, let me know when Sky comes, okay? So we can.
Will do, he's not here yet.
Transition. Okay, perfect. So let's say the burn rate. So the burn rate is how much money does a founder spend every month, or the company spends every month to keep the lights on. Oh, he just is asking to be entered. So that's the burn rate. All right. So I'm going to go
entering right now.
Yeah. So I'm going to go through these examples really quick. Okay. It's not going to take too long.
So cost regardless of whether sales change, when you said to keep, so it's just the fixed cost, there's no variable cost component, it's regardless of revenue, regardless of sales? Or
no. Yeah. Burn rate is how much do you need in order to keep this company alive, right? Keep the lights on. So in this example, let's say the burn rate is $55,000 a month, and the guy and the founder is raising $1 million. And usually you want it to last 18 to 24 months because you don't want to keep going and raising another round every 6 months. You won't get a time to, build the company. And assuming 1 million is 20%, and that's the variable here that you want to make sure that this is always around 20%. If it's 30%, 40%, you don't want to invest in a company that goes more and more, right? So assuming 1 million is 20%, then the post-money valuation is 5 million, right? 1 million divided by 20%. So 1 million they are raising, and if 1 million is 20%, then the post-money is 5 million. So the pre-money valuation of this company should be no more than 4 million or around 4 million. So if a company with this kind of values come to you and say, we are raising, $1 million, and that would be, but our pre-money valuation is 8 million. You want to ask the question. Or if they say we are raising, $5 million, and our pre-money valuation is $10 million. So you want to make sure that the money that's being raised is around 15 to 20%, or maybe 25%, but no more than that, especially in early stage.
So what if they have the valuation jacked up at a level where you're, you know, it doesn't jive, but you still believe in the founder and all of the other pieces in your criteria?
So that you're always going to have, and I know why you're asking that, Betty. You're always going to know a lot about the company if you know the founders, if you are very close to the founders, and if you really feel that the founders are, going to be successful. However, there is no guarantee. Nobody knows the future, right? The only thing you can control is the valuation at this point. So I would try to do everything possible to get as lower valuation as possible by walking him through your thought process. You are not just saying, oh, you're not worth this much, but walking them through your thought process, saying, this is what I think is worth it. Now, tell me why you feel that your company is worth $8.5 million, and or whatever, 9 million, whatever it is. So whatever so there's art and science mixed in VC investment, right? The art is the relationships, the gut feeling, the instinct, the negotiation skills, all that stuff. And the science is pure math. So you really have to balance that. And it gets difficult when you know somebody.
Yep. Okay.
Okay, so we have, VC way. So the VCs were based on the acquisition price and the desired return multiple. And I'll tell you this, and we'll go through this example really quick, right? So let's say that currently the founder is raising $1 million, and they're saying revenue in year 5 is going to be $40 million. They have forecasted the revenue for $40 million. As an investor, I always, not always, more often than not, say that's not going to, I'm going to take half of that or 2/3 of that. So in this example, I'm going to say, okay, founder, I really hope you get $40 million in revenue in year 5. But as an investor, I'm talking to myself, I'm going to calculate it that you get half of that, right? So the revenue multiple, and here is, what Sky said on Friday, which he's going to go over today as well. Depending on the type of the company, you're going to decide what the revenue multiple is. So like if it's a food company or one-time product company, then the revenue multiples are 2 times the revenue, right? So I chose 2 here. So the acquisition value for me has to be $40 million. Let's say the acquisition value in year 5 is 2 times my $20 million revenue in year 5 from the investor perspective. That comes to $40 million. And my desired investor return, what I want is I want 10x. So in order for me to get 10x, then the acquisition, so required post money in this round should be about $4 million. So the acquisition value divided by 10. And the required pre-money, because I'm raising 1 million, is $3 million. So valuation of this company is about $3 million. And if I calculate this, that what percentage of the company that's being given away in this round, it comes to about 25% of the company. But if that came to like 40%, I won't touch this deal, because then it doesn't leave anything for the founders. Or if it came out to be, really low, then I would like to understand, are you going to raise money every 6 months? Like, what's your burn rate, et cetera, et cetera. Okay, and then the fourth is the market oriented. Always read reports, understand what are the average valuation of the companies in your industry. Majority of the tech acquisitions are under 30 million. So if you are talking to a founder that say, we are one of a kind, we are going to get acquired for 4 billion, 3 billion, 1 billion. Keep this in mind, that majority of the acquisitions that happen, especially in the tech sector, are under 30 million. So does the founder who you are looking at, is he going to fall into, does he have what it takes? Does he or she have what it takes to grow the company to more than that, so it can get acquired for more than 30 million? Every founder who comes in front of you is going to say, this is the best thing that ever happened to you, Mr. Investor or Miss Investor. If you invest in this company, this is, but then you have to look at the founder and say, are you building something that falls into below 30 or over 30 or over 100? Anyway, those are some of my thoughts. And I really wanted, hold on one second. And how do I value companies? I just, again, this is more of an art for me than science at times, but these are the things that I use. Anyways, I know we have a guest, and I want to make sure you guys get to hear from him. So I'm going to stop sharing. Hey, Sky.
Hey.
Hey, how are you?
Hey, good.
So I was teaching for a change instead.
I know, it was fun. It was fun hearing you.
All right, so welcome back. For those of you who don't know Sky from Friday, Sky is a really good friend of mine, and also Jenna and Sky and Kate and I have know each other for a while, and I've asked him to share with us today the revenue multiples that we went over on Friday. That was very useful. And we are recording you today, okay? So yep. We will have that information for us, for our use later. The waterfall analysis, and yep. You had said that you will be able to send us a blank template that we can play around with.
Correct. Yep. Yeah. Okay. So I emailed it to you just a few minutes ago. But yeah, I have, I kind of, out of the much, I grabbed a few key slides. One is to go over the revenue multiples again and kind of go into a little bit more clarification around that and kind of diagramming it. Okay. Two, having to go over some of the fun venture math on what multiple rounds of financing look like, building itself into what the IRR calculation was. That was one thing that you wanted me to have. And then I have the waterfall template that we'll go over. So we should be able to include those in about an hour or so. And do you guys have, can you go over like by 10 minutes or so if it does go a little bit longer? Or
we usually do. I'm sure it's okay. Cool. But we are recording also, so whoever has to leave, we will record till your last word, and then we'll send it to others.
Nice. Cool. Let me.
Thank you for doing this, Guy. Really appreciate it.
All right, let me.
Guy, the number of tabs you have open on your computer is making me twitch.
That's actually that's a small amount. It's nice is that the browser now works, so it actually starts hiding all the other ones over on the right that you can't even see.
Oh my goodness.
Yeah, that's all. I cleaned them up earlier today just to get focused. Cool. So I one of the questions actually that you answered for me, Jags, already was whether you'd already gone over the basic definition of pre-money and post-money valuation, which you went over a few minutes ago. So that's perfect because it kind of leads right into this next part to kind of understanding what multiple rounds of dilution look like. And let's jump in. So I think
actually, Sky, I used this example exactly in one of my previous slides.
So you already covered.
Yeah, but please go ahead and go through it. I'd love for them to hear it in your words as well.
Yeah, I'm just looking. So we have just like 9 slides here, and then I'll jump into the waterfall.
Sky, could you actually do present mode or make it a little big? Okay,
yeah. No, I'm with you. I couldn't see that either.
Okay, great.
Hi. So yeah, for as Jag was going over kind of why is a pre-money or post-money valuation any number at all? And the fun thing about valuation too is that I guess one little bit of advice or wisdom I'll share with what Jags was talking about before I came on was you should never invest in a company or not invest in a company because of the valuation. You should really just focus on investing in great companies. We have a handful of case studies that we teach at VU. Andrew has a common one that he brings up, which is his investment where he passed on investing in Stripe, and the difference in valuation was like 50 million was the term sheet that RE put it forth, and then Koshla Ventures came in with a term sheet at like 75. So it was like a $25 million valuation difference. And, based on that, that seems like a really big difference in valuation. But the company is now worth 20 billion plus. And so like, it just doesn't matter on the valuation on that side. So in general, if you're going after just really massive opportunities, be a lot less valuation sensitive and be a lot more return multiple focused. So we're more than happy to come in at $1 billion valuation if we feel there's a high probability it'll go to a $20 billion valuation. For example, like in Twitter, coming in at Twitter at $1 billion valuation, having go to 20 billion and getting out, that's totally wonderful. And you're still getting your 20x. So just be mindful of that you should never just pass on a company or do a company because of evaluation. Just be less valuation sensitive and be more return multiple focused.
But there are also times, Sky, where the entrepreneur changed the valuation at the last minute.
It'd be fun for them to do that because you can walk away. They're not really the one in control usually, but it depends on how much they, what type of person you're dealing with, and that kind of goes to more integrity. So like when a VC
and also
is submitting
because the term sheet is set versus entrepreneur is calling the terms, and it's ever changing.
Sure. Yeah, that's confusing when that happens. I would, again, one of the things as a VC, when you put forth a term sheet, you have your integrity on the line. So once you put forth the term sheet, you don't usually change the valuation in the term sheet. At least the investor won't, and kind of change terms right after you get that process going. So there's also a thing where you typically don't walk away from a term sheet unless there's material reasons to do so. But usually it's a pretty strong sign. If you're doing a term sheet, you're almost certain that you're going to probably do the deal if it ends up getting accepted by the founder. So anyways, to kind of go into some venture math, since you guys already went over this slide, I'll just kind of focus on the key takeaway. As you see, kind of this is kind of looking at if you did 4 rounds of financing from seed through Series C. The key takeaway, kind of conclusion, if you've already gone through this slide, but a good one to take away is that if you look at the seed investor ownership in the top right, you have 20%. So you invested $1 million at a 4 million pre and a 5 million post. So the seed investor got 20%. After that, 3 more rounds happened. There was the A round, the B round, and the C round. Each of those rounds were 20% dilution that happened. And so really easy kind of rule of thumb is if 3 more rounds of financing happen after the round that you come in, and those next 3 rounds average at around 20% dilution, you'll end up with half the ownership that you had. So you're going to go from 20% as the seed investor to down below, you'll see that the seed investor's ownership is 10%. So you went down by half after 3 rounds of dilution at 20% each. So just a good rule of thumb that 3 rounds of dilution at 20% will give you half your ownership of what you started. Just a really good fun factoid. As actually for I love fun factoids for helping yourself also think through venture math and do quick mathematical logic. Another really good one that I just came up with recently, actually with the Laura DiCarlo deal, was if you look at the population, if you ever want to know how many people exist in the United States in a certain age range, it's really fascinating. We pulled it up. So between men and women, which are roughly 50% each of the overall population, but between the ages of kind of teenage, or really 0, kind of freshly born children, all the way up through about 70, every 10 years, every 5 years of age is 10 million people by sex. So for men between the ages of 20 and 25, there's about 10 million men in that age range. And same thing for women. For every 5 years of age, it's roughly 10 million people, all the way from 0 all the way up through 70. So again, it's just we were doing this as an interesting fun factoid. So if you're ever wondering what the number of people are in a certain age demographic, every 5 years is 10 million people by sex. So just again, fun one, because one thing you get really good at when you see lots of companies pitching you is you start doing your own market sizing analysis really quickly on the fly, and people are like, how the hell did you know that? Or you remember some fun stats like how many households there are in the United States of like about 120, 130 million, or like knowing the US population is actually a really useful basic number, that there's roughly 330, 340 million people. As a fun aside that kind of supports, we'll go into for market sizing. About 8 years ago or so, I had a social network pitch me for people that liked outdoor stuff, people that liked mountain climbing, hiking, bicycling. And they said that their 5-year projection was that they were going to have 90 million people on their outdoor social network. And I said, do you guys know what the population of the United States is? And they said, no. I said, well, it's about 320 at that point, million people. So you're saying in 5 years, you're going to have 90 million people. So 1 in 3 people in the United States are going to be on your outdoor social network. I said, just to kind of emphasize how crazy that is I'll be really generous and say that you're going to have a 10% conversion rate on your target market. So if you hit 90 million people on your platform and that's 10% of your actual target market, it means that your target market's actually 900 million people. And that's like 3 times the size of the US population. So unfortunately, your math is completely correct. The downside is those people don't physically exist. And so, again, you may just be really careful where math can be right, but it doesn't jive with reality.
And even 10% conversion, is unrealistic.
No, correct. I was being super generous.
Yeah.
If the other sense of their target market would have been 900 million. So again, the fun of that. But I'm still waiting for the first startup that'll pitch me that they're not just going after the population on Earth, but like the population on Mars to get to a bigger market size. But anyways, so but yeah, I think that the main takeaway from this slide is just to remind yourself about how dilution basically works, and you can just take 1 minus the ownership amount and multiply that. So basically 80% multiplied what you had before is that 20% dilution. All right. So this slide kind of dives into what we had reviewed last time. So, but more in a slide format. So hopefully it's easy to visualize. So revenue multiples, are there's 2 different types of multiples.
And Sky,
Yep.
super quickly, just for context, only a small handful of the women here today were on Friday. So you do have a bunch of new faces.
Cool. No,
just so you know.
Awesome. Yeah. So I'll pretend that you guys didn't hear anything that I said before, because many of you weren't here. So so there's 2 different types of kind of multiples that you can apply to kind of come up with an exit valuation or a future valuation of a company. You can either use a revenue multiple or an EBITDA multiple. And one of the fun questions that often gets asked is like, why do you use one versus the other? Well, it's hard to use an EBITDA multiple if you don't have any EBITDA. So that's kind of the quick answer. So if you are literally not profitable and you have negative EBITDA, you're not going to be using an EBITDA multiple to get to your valuation. So in general, revenue multiples are really for growth stage companies that are not profitable yet, or they're barely profitable. So that's why almost the entire venture industry is really just using revenue multiples to value companies at exit, more so than you'll ever see EBITDA multiples. EBITDA multiples are really going to be used for private equity valuations when you actually have profit or EBITDA. So the revenue multiple range, the typical revenue multiple range is 1 to 10 times. If you look at the companies, we did actually an internal analysis about a year ago when we looked at the top 50 companies by market cap that are public, and almost every single one of those 50 was up between a 1 and 10 times revenue multiple. The only 2 that were not were MasterCard and Visa, that were in the about 20 times revenues. And that's because they have a very extraordinary gross margin and highly, basically they own the entire market. So it's hard to, they have hard ones to beat. But huge revenue growth for MasterCard and Visa, great margins, very reoccurring. But other than that, every other one of the top 50 companies, from Facebook, Amazon, Google, any kind of the top 50 that are there in the top market caps, all were between 1 and 10 times. And in fact, the average was about 5 times. So even amongst the top 50 companies by market cap, they fit into these ranges of like kind of very mature businesses of that multiple. The way that you calculate that is you do your revenue in year 5, or whatever year that you think you're going to exit at. take that exit year's revenue and multiply it by a multiple between 1 and 10, and that will be your enterprise value or your exit valuation. The way that you can think about why will it be 1, 2, 3, all the way up to 10, the first is really to think about whether or not it fits into one of two types of revenue or quality of revenue. For products that kind of have one-time revenue with low to high frequency, that would be like a really good example is a mattress. I'm an investor in a mattress company, and they pretty much trade at 1 times revenue, the entire industry. And that's because you buy a mattress once every 7 to 10 years. They don't have the greatest margins. They're about 45% gross margins for mattresses. And again, relatively low frequency. Just because you bought a mattress once doesn't necessarily mean you're going to buy another mattress, even from the same brand 7 to 10 years ago in the future. So products typically have 1 to 3 times revenues in that range. And then software as a service or kind of recurring revenue businesses are usually in the 4 to 10 times range. So if you want to at least bucket things, is it a one-time product sale business or is it a recurring revenue business? Kind of gives you into the two kind of bucket ranges of either 1 to 3 or 4 to 10 on that revenue multiple range. Another question you then ask is, well, how do you get kind of more specific? How do I know if it's a 1, 2, or 3, or within the 4 to 10? So how do I know if it's on the low end or the high end? And again, multiple range is really based on 3 core criteria. One is just revenue type. Is it one-time revenue or reoccurring? 2 is it low gross margin or high gross margin? So low gross margin is basically anything less than 50%. Then when we kind of keep it at like the one times revenues or closer to the 4 times revenues. In the event that you have higher gross margins of 66% or above, then you can kind of push your 2, 3 times revenue multiple if you're a physical product that's occasionally being sold, or can be on the 5, 6, 7, 8, 9, 10 on the higher side if you can have higher gross margins for SaaS businesses. And then lastly is revenue growth. So the bigger your revenue growth, the more likely you'll be at the higher of that range. For enterprise SaaS, the general rule of thumb is anything over kind of 20 to 30% revenue growth month over month. Every 10% of additional revenue growth gives you an extra 1x. So you can kind of think of yourself in that range of 4 to 10. Once you're kind of looking at like the, for every 10% extra, you're getting an extra 1x, and you don't really get any benefit for growing more than 100% month over month. So, you can do it, but just you're not going to get the revenue expansion. So,
Scott, I have a question here.
Shoot.
Jax. So I remember you do work with a lot of food companies too, right?
Yep.
CPG companies. So RX Bar, when they were acquired for 7 times revenue.
Yep.
So that, in my opinion, is a little bit high, but it's also recurring revenue is high, right? I mean, people keep buying that stuff. If they
Sure.
like it, they stick with that. I don't know about their gross margin, but how do you have any insights on the food companies maybe?
Yeah, so there's certain nuances certainly to certain categories. So whether you're talking about fashion versus food versus beverage, there's nuances to how those multiples work. So in beverage, for example, even though it can be considered a high frequency item, a lot of people just kind of try beverages too. And what's interesting about the beverage space, kind of as an example, is usually when you get to around 10 to 15 million in revenue in the beverage space, you can actually get acquired for usually about 7 to 10 times revenues for beverages. Which as a tech VC, most of my life, I was blown away that beverages would get acquired for 7 to 10 times revenue. And like, how does that make any sense? The reason it makes sense is you're only doing about 10 to 15 million of revenue, and you're basically selling into your growth for the likely strategic buyer is going to push you through their distribution channels and immediately make a lot more money out of your brand. And so in a world where the only growth of beverage is really these micro brands that are starting to pop up and are kind of being aggregated, it's becoming a very common trend that you can get acquired for 7 to 10 times revenues at the earlier stages, or if there is still a really large amount of growth that you can grow into by the acquirer. If you were to be purchased by more of a private equity fund, not a strategic, where there's like with a strategic, they can pay more because they can actually do things to make your revenue grow a lot more. If you were to be acquired by a private equity fund, you're going to fall a lot more into these typical valuation multiples because you're really just being acquired for your own current growth and your own ability to grow yourself. So again, there's a little bit of a nuance of whether or not the multiple is being applied from an acquirer that can strategically move the needle for you, or a private equity fund that's going to be more just kind of leveraging, like having you just keep growing on your own with internal cash. From a public markets perspective, the public markets will pretty much give you more of the more rational multiples, and are usually the most fair. Strategics are always fun. So when a strategic gets acquired, when a strategic makes an acquisition, that's kind of where there's no more rules. Kind of rules go out the window with strategic purchases. So like RX bar, it could really be whatever the strategic wants to pay for it. And that's actually one of the beautiful things of the venture capital industry, is it's the only industry where you can have irrationality make sense. And so the way that you get companies like Cruise Automation to get acquired for $1 billion within 24 months of launching is because you're going after tremendously huge market opportunities like self-driving cars. You have dynamics at place that threaten significantly big auto manufacturers like GM. And you had a company with Cruise's situation. Cruise was potentially about to close $100 million round at a $500 million valuation. And so all that kind of mixed together made GM say, okay, I'm going to buy Cruise for $1 billion, only within 12 months of the company, 24 months of the company being around for. So whenever you're dealing with the strategic play, valuation multiples really do go out the window for the most part, unless it ends up being just more of a financial buy. Then they're going to act a lot more like a private equity firm in how they're making their purchase.
Is a good example the Visa Stripe purchase?
I don't know the dynamics. What was the conclusion on that?
$5 billion valuation.
Do you know what they were doing in revenue?
I don't, but
I think
it was definitely like it was, a blowaway number.
Yeah,
and I know
I'd be curious of whether or not they were doing like 500 million of revenue, because if they were doing 500 million of revenue,
it's 10x, yeah.
Yeah, so could be totally reasonable. Like, I give another example. I'll kind of move forward to one of the. I'll skip forward. I'll come back to one of these slides. But like, I did. There's a company called Beyond Meat that many of you are probably familiar with. So I was the largest investor in Beyond Meat prior to the IPO. I was the largest dollar investor, and I was on the board of directors. My investment ended up returning more than 2 times my entire fund within 3 years of launching the fund. And so that was fantastic. I turned like $20 million into over $200 million. Now, when I was making the investment Beyond Meat, I was expecting that maybe I would make like a 3x to a 5x on my investment. And I was investing out of a $125 million fund. And I built up my dollar amount over time into Beyond Meat to where I had $22 million of my $125 million fund in Beyond Meat. So my largest stake of any portfolio company. But I was thinking maybe I would get like a 3x to a 5x after all of the multiple rounds of doing much more than my pro rata. That if I got like a 3x on 20 million, I would return 60 million, and I'd return half my fund. And I'd be like so happy if it returned half my fund. If I got a 5x on 20 million, now I'm almost returning my entire fund, turning 20 million to 100 million. I had no expectation that Beyond Meat was going to trade at 40 to 50 times revenues. Like when it went public and it was trading at 40, 50 times revenues, I was like, I just can't wait until my lockup period ends so I can sell, because this is like crazy. I don't know how long this will happen for, but there's no way that I was going to project that Beyond Meat would trade for 40 to 50 times revenues. There's nothing rational about that other than the retail market just really wanted to own this company. And so if we looked at comps, this was the comps of what I looked at when I was making my investment. If you look at the next generation of companies, they were like between 5 and 20x. I was guesstimating maybe it would trade at like, again, maybe 7 to 9 times revenues. I was not expecting the 30 to 40 to 50. So again, I'd rather be lucky on that stuff than project that would actually happen. So anyways, I'll go back to
Sorry, can I ask a quick question?
Shoot.
Sorry. Oh, go ahead, Amber.
Thank you. Very quickly, do you have a view on how Nikola, which was trading pre-revenue, managed to get the valuations that the market was pricing in when it
Which company was it?
Nikola, which is like the
It's
the
a
new
public
entrant
company.
to the Tesla space. So it's the similar
Okay, yeah, and not familiar. I haven't tracked that company too much, so
Thank you.
yeah, can't help. All right, did someone else have another question?
Yeah, I had a
Katie?
quick question. On your beverage multiples, does that include alcohol or is that non-alcoholic?
Yeah, it's basically just situations where an acquirer could significantly push you through their channels to really grow revenues significantly. So it would be true for even food. If you think of there's an aspect of capital efficiency, I guess, that could be a whole nother hour conversation on. But capital efficiency is also very different in how that impacts what the final revenue multiple will be as well. I've invested in companies that have just amazingly high capital efficiencies, and they don't have to raise as much capital to get to big revenues. But like if you look at the difference between the fashion world and the food and beverage world, like at maturity on their own, they kind of trade at the 1 to 3 times revenues. But the difference is how much capital you have to put into them to get there. So food and beverage is really not capital efficient. It's one of the least capital efficient industries you can have. Versus fashion is a lot more capital efficient. You can get to 5-10 times capital efficiency with launching a fashion brand without actually spending that much money. It's also just because like the industry that it's in, people talk about fashion a lot more. They're always wearing it and talking about it wherever they go. People tend not to be as vocal about the things that they drink and eat. They do a little bit, but not nearly as much as fashion. And so there's a little bit of extra virality to fashion compared to food and beverage, even though they initially trade at the same multiples. For the most part, just capital efficiency is like night and day. So, all right. So then EBITDA multiples, next slide. So EBITDA multiples typically trade at usually 10 to 20 times EBITDA if you have EBITDA. And usually I'd say anything at 10% or more of an EBITDA margin is when it's appropriate to start using an EBITDA multiple. And whether you use an EBITDA multiple or a revenue multiple, ideally, if you have 10% EBITDA margin or higher, the EBITDA multiple valuation and the revenue valuation will oftentimes be the same thing. And so the reason that EBITDA multiples are 10 to 20 times versus revenue multiples are 1 to 10 times are 2 reasons. One is that the conclusion has to be the same answer. So whether you're going to multiply, by 1 times revenue or 10 times EBITDA, the end answer has to be the same roughly.
So, Sky, we haven't gone over EBITDA. So do you want to just give a simple definition of EBITDA?
Yeah, absolutely. So EBITDA is earnings before interest, taxes, depreciation, and amortization. Rather than going into what those specific things mean, just think of EBITDA as the amount of cash that you have after you've paid for all of your operating expenses and after paying for your cost of goods. So it's kind of revenues at the top minus your cost of goods minus your operating expenses equals your EBITDA. There's stuff below EBITDA, but don't focus on that for now. Just think of EBITDA as like your remaining profit for what you have. It's a pretty good barometer for your free cash flow or how much cash flow you have. The one exception to that you have to be mindful of is that the math that we just went over is not inclusive of if you purchase any assets. So if you did buy assets separate from operating costs or your COGS, but like you bought a bunch of inventory, you put a down payment on a building, all that stuff does not get included in your income statement for what EBITDA is. So you could be technically EBITDA positive, which makes you think you're positive on cash flow, but in fact your total cash flow is also reduction of assets that you purchase, and that could actually make you negative in cash flow but positive EBITDA. So again, assuming that you don't have like a super capital intensive business, then usually EBITDA and cash flow line up really nicely. It's only in worlds where you have a lot of extra capital expenditures outside of your operating business where that'll deviate significantly. But just think of EBITDA as basically your ending cash after your operations have been paid. And the reason that private equity firms and people like to buy companies on EBITDA is if it's free cash flow, you can do other stuff with it. You can go and distribute that cash back to your investors. And the company could like flatline on revenue, but just keep on producing positive cash flow and just sending it back to your investors. And it could totally be a great, return for you as an investor. But you can do other stuff with it. And so if you put yourself in a perspective, there's an example we do at VU for building out a financial model, and we do a restaurant, a Chinese restaurant in San Francisco called House of Nanking. We build out the financial model for that restaurant, and you put yourself in their position. Like if you were the owner of this Chinese restaurant and you were throwing off 500,000 in free cash flow a year, how much would someone have to pay you to buy your restaurant? Like, would you sell your restaurant for 500,000? Probably not, because an extra year goes by, you have another 500,000. So you start thinking of, well, what is a multiple on my free cash flow that I'd be willing to part with my company versus the long tail of just being able to continue to have that free cash flow to go and buy real estate or do whatever investments I want to do or just get richer from it. So again, that's basically the play at hand is where, at what point are you willing to sell a business for immediate cash flow, for present value of cash, versus the long term if you just keep operating the company. A fun link here too is if you there's NYU Stern, there's a professor that keeps this updated, but there's a really good list here of revenue multiple by sector. So if we look at kind of enterprise value by sales right here in the second to the last right column here, it has a bunch of kind of industries and X number of companies per, like here's oil and gas at 2.7 times revenues. So it's a really good kind of one if you want to grab it to kind of figure out what a comp looks like. But in general, I never even use this because you kind of know what the ballpark is from just the methodology I went over. So no longer actually really have to do comps. Comps really are, you can just create your any comp list to match up with whatever multiple you want anyways. It's kind of like everyone's always number one in a league table because you're picking what you're defining yourself around. So again, comps will just match up with whatever you want, but I would just use the typical rule of thumb of how we decided if it's 1 to 3 times revenues or 4 to 10 times is really your best guess, and you'll be the safest by doing that. All right, cool. Now I want to go over kind of an example of where valuation does matter, and maybe you shouldn't be so insensitive to it, but it really is where the upside or the overall return for you is not that great. So again, be more return multiple focused than valuation sensitive. But if you are return multiple focused, then you should have been careful about what the actual upside actually was to begin with. So kind of give an example. This is getting you in the mind frame of where an angel can start thinking a lot more like a private equity investor and actually protect themselves in making bad investments. So if you were to invest in a company at the same revenue multiple that you exit for, you have much lower risk, right? So if you invested in a company at let's say a 3 times revenue multiple, that's what it was valued at when you invested, and then it exits in the future at 3 times revenues, all it had to do was grow revenues and exit at the same multiple that you came in at, and you make money. Versus if you have to grow into the valuation, you have a lot more of risk that's being built in. So here's a good example of that. So let's say you invest at a $30 million post-money valuation, and the revenue multiple is 3x. And so the company is doing about 10 million of revenue, and so you're going to value it at 30 million. Then 5 years from now, the company is now doing about 100 million of ARR, annual reoccurring revenue, or annual run rate of revenue. 2 different definitions, by the way, for ARR, depending on if it's a reoccurring business or non-reoccurring business, but it's both ARR, either annual run rate, which is just your current month multiplied by 12, or annual reoccurring revenue, which is more of a subscription revenue, but they're both ARR. Basically just gives you an idea of what using the current month multiplied by 12 of what your revenue would be. So let's say in 5 years from now, the company is doing 100 million of revenue and exits at 3 times revenues, means the company will exit at $300 million. In that situation, you're happy. You came in at a $30 million valuation. It exits at a $300 million valuation. You make 10x, assuming that there was no other rounds of dilution in between. If you did have one more round of dilution, then your 10x would go down to like an 8x if the round that happened after you was a 20% ownership, as an example. But you can see here that if, as long as you invest at a rational multiple for the same multiple that it'll exit at, then all it needs to do is grow revenues and exit the same multiple, and you make money. So again, much less risky. And if you can invest in a company at a valuation where the 20% ownership value piece of the valuation equals what a revenue multiple is, just call yourself lucky. That doesn't happen all that often, but the closer you can get to where a revenue multiple equals the ownership when you're doing the 20% giveaway rule of thumb, it's a really good place to be. Now, on the flip side, if we look at investing at a higher revenue multiple compared to what its comparables are, this is really where you get stuck. So let's say you invest at a 5 times revenue multiple in a business that's doing about 100 million of revenue. So you value it at 500 million. Similar companies, however, in the public markets only trade at 1 times revenues. So this would be an example of like Casper. Casper was raising capital at significantly higher than 1 times revenue multiples. They were doing 5, 7, 10 times revenue multiples for their financing rounds. And then by the time they went public, well, Casper as a mattress company just got traded at 1 times revenues and didn't have any other premium from being in a top brand in the mattress space. So it's really sad because 5 years later, you might be doing 500 million of revenue, which means you grew from 100 million of revenue to 500 million of revenue. You added $400 million over 4 years. That's pretty impressive, but you only trade at 1 times revenue. So you're only worth 500 million, which means now you came in at a $500 million valuation. And then 5 years later, it's still only worth 500 million. And you're kind of thinking, shit, the company grew a whole bunch of revenues, but I didn't make anything from that. So that's where, the upside wasn't as big as you actually needed it to be to grow into that valuation and have the valuation then exceed the valuation that you came in at.
Who would you like to FaceTime with?
Who would I like to FaceTime with? Is that what the question?
That's what I heard. I'm not sure what she meant.
I guess I would love to FaceTime with Tim Cook with Apple. I'd love to ask why Apple has become the least innovative company out of all companies in history.
Gary wants to know. Sorry about that.
They have more cash than any company in history, and they seem to have a hard time figuring out what to do with it. And by buying stock back is basically an admission that you have no better ideas of how to use that cash other than to buy stock back. Amazon doesn't have a problem of figuring out how to use its cash. Neither does Tesla, neither does Google. And I think the best thing would be like Elon Musk becoming the future CEO of Apple, because I think he'd have a fantastic use of that amount of cash. But yeah, I'd love to talk to Tim Cook and share that with him.
That was a very unusual question and even more unusual answer.
So anyways, do some fun IRR calculations. So IRR is your internal rate of return. Your internal rate of return, you can think of it in a simplistic way as it's basically compounded interest on how much you're making on your money over a given period of time. IRR goes up if you return money sooner, so it's time sensitive. So the faster you get money back, the higher an IRR number is. The longer it takes money to come back to you, the lower your IRR is. It's also volume based as well. So the more money you get back sooner, the higher your IRR goes, and the less of capital that you get back in the future, the lower your IRR. So it's both time and volume impacted. And so as a kind of a fun example here, if we looked at putting $1 million that we invested in January of 2014, and we didn't get anything back for 5 years, and then in June, mid-year 2019, we got back 20.8 million. We would have made a 20.8x, so that'd be a nice return. If it was based on equal increments, so if you assume that every column was its own separate year and wasn't time-based, your IRR would only be 66%. Again, that's assuming if every column was its own full year and not by the midpoint there. But if we change the last column to June instead of December, and we actually calculate IRR based on a time, then IRR goes up to 74%. So kind of, it's definitely time impacted. To give an example of where, how does this math of 66% even make sense? If it was by equal increment, the kind of proof here is just by quickly seeing it. So if you turn $1 million and you grow $1 million by 66%, that'd be 1.6 million. If it keeps growing by 66% every year, compounding on itself, you'll eventually end up at 20.8 within that time period. So it really is the easiest way to think about IRR is what was my compounded interest rate of my money making money on itself. Now, the sad thing is in venture and angel investing, you don't see this happen. So it's more of an effective IRR because you basically have nothing happening in the middle. No money is given back to you. In fact, you might even be putting more money in. And so it's hard to really think an IRR in the venture industry, given you have such a low success rate in deals that you do. Usually angel investors and VCs don't think in IRR. So we pretty much only think in return multiples, and the some safe guidelines around return multiples is a venture investor is really looking for 10 times or more in every deal that they do as a minimum. Private equity is usually in that range of that 1 to 10 times range, or call it 1.5 to 10 times. They're looking to definitely get more than their money back. So call it 1.5 to 10 times. And then angel investing is 20 times or more. The other thing to keep in mind is if you were thinking from a venture fund's perspective, it's also when you think about the follow-on capital that you're putting into a deal, now you're thinking about the holistic return of your fund. So it's not just the individual deal return, it's will a particular deal have the capability of returning around a third of my fund to a 1 times my entire fund. That's kind of the mentality you need to get into, which is not just how much that one deal will return for you. Hopefully that one deal will return 10x to 100x or more. But if I keep on doing my pro rata, or I put in more capital into that deal, I'm no longer being specific company focused. I'm now focusing on, will it return a third of my fund to 100% of my fund? So it changes once you start thinking about follow-on capital. But if you're just thinking of initial investments, think about 10 times or more, or 20 times or more if you're an angel. Here's a nice chart that I made many, many years ago. It's somewhat well known. If you were to Google IRR analysis, I should do it just for fun. I always like to see how it's doing. So if you were Google IRR analysis, if you ever want to find this in the future, click Google Images with IRR analysis, and it should come up right there. So good resource. It's one of the top kind of viewed image on looking at what IRR looks like from a matrix perspective. So the way that you use this, and go back to view, is if you want to think of investing over a certain number of years between 2 and 10 years and a return multiple of 1.5x to 10x, it's basically a matrix. It's just an easy way where you can start memorizing some of these numbers. If you were to try to get a 5x in 5 years, it's basically a 38% IRR. If you were to get a 10x in 5 years, it's a 58% IRR. We got a question here. Let's see. Eloquence. Yes, that's on there too. Thanks, Kate. So again, nice cheat sheet if you are thinking about IRR, but in general, we just don't usually pay too much attention to IRR when we're making investments. We're just return multiple focused. So that's the end right there. Now let me jump into the waterfall analysis.
And this is something I believe is even more important than IRR, especially.
Oh, for sure.
To understand what the value will be when we cash out.
Yep. So for a waterfall analysis is to really go over how much will you actually net out from a return perspective after all cash has been paid out to all debt holders, banks, preferred equity, and then to common equity. So it is the full waterfall from beginning to end.
Hey, Sky.
Yep.
Will you be okay sharing your slides?
I did, yeah. I emailed you the deck as well as the Excel template. Yep. So you have it. Yep.
So yeah, we'll include that with the other presentation.
Yep. So for the waterfall, we kind of have two tabs here. So we have the no pro rata tab and the pro rata tab. So pro rata is if you're going to maintain your ownership all the way through with every round, maintain that ownership by putting in additional capital. And by putting in additional capital to maintain your ownership, your return multiple will go down because you have more capital at higher valuations. So your overall return multiple will go down in your pro rata return. But that's not a bad thing. It just means that you have more money that's going to win. Versus your non-pro rata is really you participate once, you never participate again, you allow yourself to be diluted, and you're going to have the really high return multiple, but it's going to be on a much smaller amount of money.
Sky, can you present?
Oh yeah, sorry. It's can you not see my screen?
We can see. Can you put in the present mode?
Oh, gotcha. I don't think I can do that with I can only zoom in. So let me
Oh, okay. Oh, because this is a spreadsheet.
Yeah, spreadsheet. So what we have here, the way that the template is set up is we have three rounds of financing. So we got all the way on the left, we got a seed round, then a Series A round, and then a Series B round. And so I'll quickly walk through these just for the setup, and then we'll jump into the below waterfall. So assuming the first round, the seed round, is an 8 million pre with a $2 million round, with VU putting in $1 million and another investor putting in $1 million. So that gets you your two. Gets you a $10 million post. Ownership is 20%. If there was situations of a liquidation preference of how much you get back first before you get common equity, you could put a liquidation preference here. And then assuming that your two more rounds happen, your A round and your B round, my 10% would go down to 8% after the second round. So after the Series A, which will be a 20% dilution, goes from 10 to 8%. Then with another 20%, that will bring it from 8% down to 6.4%. So if all you did was invest the seed round, by the time the Series B round happens, you'll own 6.4% of the company. At this point, the company will have raised $2 million and you'll have $1 million invested. So we go over to the Series A. It's a $20 million pre, a $5 million Series A. So it's a 25 post, giving away 20%. In this case, we're not putting in any more money. So no more additional capital. We're not going to do our pro rata. We're going to allow ourselves to be diluted. So we go from 10 down to 8. If we wanted to do our pro rata, how much would it be? The easy math for calculating your pro rata is it's just your ownership amount multiplied by the size of the round. It's actually that simple. So it's your ownership amount multiplied by the size of the round is going to be your pro rata amount if you wanted to maintain your ownership. So here you can see that we're not putting anything, we get diluted down to 8%. But right here we're calculating our Series A pro rata, which again is 500,000 multiplied by our previous ownership of 10%. 5 million times 10%. So if we put right here 500,000, we are going to buy an extra 2% of the company, and now the 2%, the new 2% that we just purchased plus our old 10% that got diluted down to 8% is now back to 10%. So again, it's the simple math basically for calculating your pro rata, whether you want to include it or not. But again, this is the no pro rata tab, so we're not going to include it here. At this point now, we will have invested a total of still $1 million because we came in for extra capital. And then the third round is a Series B, is a $10 million round at a 40 million pre and a $50 million post. So 20% giveaway, which is going to, again, we're not going to participate in the round. We're going to be diluted down to 6.4%. And the company has now raised a total of 17 million. So they went from raising 2 million to 7 million to then, they went from the $1 million round to the $5 million round, $2 million round to the $5 million round to the $10 million round. So in a total of 17 million across those three rounds and only having $1 million for ourselves. So now we can go down to the waterfall itself. So the first part of the waterfall here is downside protection and really just getting a sense of how much does this unknown theoretical company have to perform just to get our money back, because we all know the actual downside, which is that we're just going to lose all of our money. So that's the ultimate downside. But what is the situation of actually just getting our money back? What has to happen for that to happen? So here, if we were just looking at the seed round, and the exit valuation here is 2 million. So again, we look up here, the company raised 2 million. So the question is, how much does the company have to sell for just to get $2 million back to pay off the investors their 1x? So if you need to sell the company for at least 2 million, and let's say it has a revenue multiple of 1.5x because it's not doing so well, so we're not going to give it too high of a revenue multiple, then it needs to be doing at least 1.3 million of revenue to have like a rational exit at a very low multiple to get to 2 million. In this case, we have right here bank debt. There's no bank debt in this company, so it was never a good enough company for a bank to ever want to give it money. So it doesn't have that to pay off, which is good.
So, but if there was a bank debt, that would be a senior debt, right?
Yeah, correct. If it was bank debt, yeah. So if it was bank debt, it would be senior in liquidation to preferred equity or common equity. So you would have to take that out first. So again, if we wanted to put like 500,000 here, we want to put 500,000 here. Now we need to kind of figure out how to get this to being, at a point where we can still get to 2 million net for the investors. So you'd have to put it up. Here we go. Is this not calculating correctly? Let's see. 2 million. Oh, I have it where it's forcing it right there. But again, you basically have to increase it, so the valuation would have to keep changing.
Yeah.
We'd have to sell for an extra 500,000 basically.
Right.
Obviously the Series B has not happened yet. The Series A hasn't happened yet. And then ultimately you're down here waiting on saying, well, am I better off just getting my 1 times my money back or getting my ownership percentage of the company? And so now you're in that question mark of, I want to get back the greater of 1 times my money or the percent ownership of the company. In these downside scenarios, you're just going to get back 1 times your money. So the common equity value is always going to be worth less than getting your money back. So you'd always choose to get your money back than getting the common equity ownership. Same thing plays out here for the Series A and the Series B. It just basically means that you have a higher hurdle for how much money you have to sell the company for. So in these situations, you had raised a total of 7 million, or at this point, you had raised a total of 17 million. And so here, even if you use the 1.5x revenue multiple, you have to now be doing more in revenues to actually justify hitting that. So you can see here where as a company continues to raise more capital and there is no real traction happening, you're starting to grow above and beyond. Your valuation is growing well above what your traction is to support the valuation. This is the Excel spreadsheet of what I had. Oh, got it. Then as we go into kind of neutral territory, neutral is basically where the company sells at the last valuation that you came in at. So you invested at a $10 million post for your seed round. So we were putting in a million on our side. It was a total of a $2 million round at a $10 million post. Means that as long as the company sells for 10 million or more, we'll at least get our money back. And anything above a $10 million exit after we do the seed round, we'll make money. We'll make a positive return if it sells for anything above the post-money valuation that we came in at, assuming that there was no other rounds that happened after us. So always to think that neutral is basically selling for the post-money, at least from the last round that I came in at. And then the real fun part of the waterfall then is looking at what the projections are. So just kind of using dummy data here, but if we did 20 million, 60 million, 100 million, let's say we did a ballpark as a midpoint of revenue multiple between 1 and 10 at 5x. Here you'd sell for 100 million, here 300 million, here 500 million. There's no bank debt. In this case, you're not going to have to pay back any of the preferred equity because common equity is going to be worth always more than all these. So here you actually had at least the 1x's that you were paying back. But now over here, there's zeros because the common equity value is worth a lot more than the 1x. So assuming that it's convertible preferred equity and not participating preferred equity would certainly be the case. So here you're now in a situation where if you take your ownership amount, so here we took our last ownership, which should be right here. So we ended off on 6.4% after being diluted for 2 more rounds. And so 6.4% times 100 million is 6.4 million. We invested $1 million to get back 6.4 million. So we got a 6.4x. And then obviously with higher exits of 300 million, 500 million, we're now hitting 19x and 32x. So here you're kind of in a ballpark of where this is an okay deal for venture angel. You're definitely over 10x, and 2 more rounds of dilution have happened, and you're even after those 2 more rounds of dilution, you're still getting above a 10x. Over here is a new part of the waterfall that I've developed, which is a matrix for yourself. So if you want to look at what the range looks like between a 3, 4, and 5 year projection, and kind of taking the average midpoint between 20 and 60 or 60 and 100. And if we want to look at a revenue multiple range where it's not just one particular one, but a range, just sneeze. Then you have 5 times 60 million would then give you an exit of 300 million. So you can have a full matrix of what your exit valuations look like. And then from a return multiple for yourself, if you were to hit kind of a 5x revenue multiple when you're doing 60 million of revenue, you're going to get a 19.2x, which kind of gets us the number that we had over here, or a 32x at 100 million of revenue times 5 is 500 million. And if you kind of multiply that by your ownership and the dilution, gets you your 32 exits, your 32 times return. So good range here of what you could have. As a fun example, we're doing a deal right now, which is extremely, we just announced it to the syndicate a few hours ago, but it's a company called Nautilus. Their revenue projections are closer to 11 on the more conservative side, 11 billion. And we think it'll trade at like a 2 times revenue multiple. But we think you can get to about 11 billion of revenue in the ballpark of around more of like a 10-year, 7 to 10 year time frame. So, to replace 5 with 7 to 10. And in the case that we had, here it's showing 1400x if we did the above scenario. But if we want to quickly modify this for what Nautilus kind of looks like, it is give an example. It's a $6 million round at a 20 million pre. So kind of just show the working of the template. 6 million. So the round itself, we're getting it's roughly about giving away. Actually, it's a 25 post, so I can kind of bring that down. It's actually a 19 million pre, so 25 post. So we're getting about 24% ownership of the company, putting in $1 million. The company is planning to raise a second round of about 25 million. So they're going to raise 6 million right now that we're leading the round in. Then they're going to raise a $25 million round at about 100 million pre. So they'll put it at 125 post, giving away 20%. And then we assume that they're going to raise probably $100 million round. And that'll be probably at a 400 million pre. Again, 500 million pounds, so 20% giveaway. So we come down then here, this scenario, our return is like in the 500 times range. So for turning $1 million into 563 million, basically is what we're kind of looking at. It's one of the largest deals that we will have done in the fund, and we're leading the round, but a truly massive opportunity. And again, love those. I'd love to do multiple deals like that. If we can. But again, it's a really good, useful matrix for quickly putting together what you think the return will be. The only difference on the pro rata tab here is that you just choose to put in what your pro rata investment amount is, and then the bottom is still the same. But it just makes it easy, so you don't have to keep editing it, you can kind of have two different instances of your model between both of them. So I'll stop there because I know we're at time. But it's a really good, straightforward template that can kind of give you an idea of the true cash flow going through. And this, you can modify this depending if you have participating preferred where there's 1x and your common equity ownership, so you're kind of double dipping. But in most cases, you're going to have just convertible preferred, which is going to be the greater of 1 times your money or your common equity ownership.
Right.
So
How often can you negotiate 1x plus common equity?
say it again.
How often can you, or have you had any opportunities where you got 1x as well as the percentage that you invested?
Oh, we're doing a Nautilus actually. So Nautilus is participating
really?
preferred.
Plus the equity?
Yeah, it's 1x plus the common equity. Yep.
Oh,
So yeah, it's really part of it is whatever you can negotiate. Market standard right now really is most term sheets are convertible preferred and not convertible participating preferred. Usually it comes down to whether you're in a more powerful position as an investor than the founder and how much they need the money. It's only going to give you an extra 1x. So it's not like the biggest thing in the world, but it does give you an extra 1x.
It's like getting your principal back plus.
Yeah, so it's a little bit of a sweetener. It doesn't like change your life, but it's an extra 1x. I think what's more important are the other aspects of the term sheet, like having things where if the company sells for less than 3 times that we invested, we have a say of whether or not they can sell the company. Those things are going to be a lot more important for our final outcome.
Yeah.
Quick note,
questions.
Sorry, just a quick note. If anybody, we are a bit over time, and Sky, thank you so much for staying with us. I just want, anybody can stay. I just want to let anybody who does need to go, as usual, please feel comfortable to leave, and you'll get the recording. So I just want to make sure people have that door open for them.
Well, I don't have anything immediately after this. I have something in about an hour, but happy to answer any other questions.
This was fantastic. Thank you, Sky. This is so this is the slide that, remember, I had I think last week, and we were talking about the participating and liquidation preference, different scenarios. And I think Katie and everyone said we should have it in a spreadsheet. So there you go. It's in a spreadsheet for you.
And you can customize and play with it depending on what. If you can, the other thing here that where the nuances are going to be if you have multiple rounds of preferred, the question there is going to be whether the preferred are senior to each other or they're pari passu to each other as well. So if the A, B, and C rounds are pari passu, then in the event that the company only exits for the amount of total preferred that was raised, then everybody gets their money back. But if the Series C is senior to the Series B and the Series A, well, now the Series C gets their money back first, and only once they get 100% of their money back first does B and A actually get any money. So you can modify this model based on the rules that are set up in the waterfall based on the terms of those investment rounds. But in most cases, pari passu, but there's certainly, as things happen, you'll start, it's certainly in much later stage rounds, you'll start getting where the rounds will be senior to the previous preferred equity.
So so as an angel investor, you don't actually have much choice to the later terms, right? If
No, you're correct. The main thing, correct. You're kind of at the whim of you just should expect that you're going to be junior to the preferred that's coming in. The main reason of why rounds will stay pari passu is if you have a lot of prior investors coming back for their follow-on capital and doing their pro rata. The more you have prior investors participating in future follow-on rounds, it's easier to negotiate that it's pari passu. But if you have a completely new set of investors in a follow-on round, that it's just a lot more likely that they'll be senior.
Yeah. So guys, if you guys don't have any questions, we can let Sky say thank you, Sky.
Cool.
Thank you for also giving us slides and this model. Really appreciate it.
Absolutely. If you guys have any other questions, let me know.
Awesome.
Yep.
Cool. Thanks, everyone.
Thanks,
Sky.
Cheers.
Thanks, everybody.
Any questions? I think I know it was probably a lot, and overwhelming. And I know we all are at a different stage as far as the investment experience. So my and Kate's intent was not to overwhelm you, but also just to, let you hear it from other folks. And I actually would love to hear, if this was not useful, we will not include that in the future session, if it was just become too overwhelming, right, Kate? So any feedback you guys have, that
I
would
thought
be
it was great.
okay. Good. Okay.
Fantastic.
I agree.
All right. And no question is, every question is welcome. So you guys digest this, and we can meet each other on definitely Thursday, but also Friday to go over some of this.
Thank you.
All right. All right,
Great.
guys. Have a great night.
Have a great night. We'll
Thanks,
pass
Vicky.
on stuff in the morning.
Sounds
Bye.
good.
Ciao.
Thank you.
Jags and Kate, I'll send you an email. I owe
Okay.
you guys an email.
You got it. You got it.
Yeah.